we'll start the third chapter now. And the third chapter is all about choosing a form of ownership. On the basis of ownership, management, and control, we'll be classifying business entities in three categories. And those three categories will be dealing in this particular chapter. When you are making your business plan and you're presenting it, normally students present it as a partnership business, but you could also form a corporate form of business having limited liability as a shareholder. So, all those things we are going to cover in this topic. But remember, there is no one best form of ownership when you are choosing a particular form of ownership as far as business ownership is concerned. The best form of ownership depends on an entrepreneur's particular situation. The key to choosing a form of ownership is understanding how each form's characteristics or features affect an entrepreneur's specific business and personal circumstances. And these factors which you need to take into consideration is the tax consideration. Fortunately, when you are starting business in UAE, we do not have any direct tax in the form of income tax. But when you are starting business in UK, US, etc., you have tax as an important consideration. Secondly, the liability exposure. Let's say you want limited liability of owners, then sole proprietor's business is not the right form. So, if you want limited liability of the owners, and then the best form of business is the corporate form of business or company form of business. Thirdly, start of capital requirement. If the capital requirement is small, then you could start a business as sole proprietor, as a sole owner. But if you need larger capital, it's better to form a partnership. If you're still larger, want a still a very large capital, then the best form of business is the corporate form of business. What do you want in terms of control? If you want absolute control in the business, no interference from the partners, then in that case, the best form of ownership is the sole proprietors. In corporate form of business, there is a differentiation between ownership and control. The owners may not necessarily control the business. Owners are the stockholders or the shareholders. So if you want absolute control over the business, then you can have as a sole proprietor's business. Managerial ability. As you know, the sole proprietor's managerial ability is limited. If you form a partnership and if you have 4, 5, 6 partners, then you will have more managerial ability. Managerial duties, responsibilities could be shared. Business goals, management succession plans, cost of formation, etc. These are the criteria in deciding the right form of ownership. Like, for example, the corporate form of business or the company form of business is the most expensive to form. The least expensive is sole proprietor's business. So, if cost of formation is one of the criteria, then accordingly you need to make a decision. The fourth slide is about the forms of ownership, as I have already discussed with you, that there are three types of business ownership on the basis of ownership, management, and control. One is sole proprietorship. Sole means one. A business which is owned, controlled, managed, financed by one person. Second one is partnership. A partnership is a business which is owned, controlled, managed, financed by two and more individuals. And third form of business, as you could see, is the corporate form of business, the company form of business. As you know, in this country, we call it LLC, limited liability company. As you know, in UK, there are two different types. One is called public limited company and private limited company. That's again a corporate form of business. Let's come to slide 5 and we talk about advantages of the sole proprietor's business or sole proprietorship's advantages. Sole, as I said, one, a business owned, controlled, managed, financed by single individual. It's simple to create, very less legal formalities whatsoever, least costly form to begin. The entire profit is taken by the single owner. There is no division of profit. As far as the decision making is concerned, the entire decisions are taken by the sole proprietor. There is no one to interfere. For example, in partnership, you will not be able to understand the distinction unless we have the relative comparison. Like, for example, you have a partnership, you cannot take a decision unless you consult the other partners, unless they have given you the mandate that you can take a particular decision. No special legal restriction. In this format, the type of business entity having very complex legal restrictions are the company form of business. And the last one, it is very easy to discontinue. As a sole proprietor, if you want to discontinue your business, it's easy. Whereas the corporate form of business is very, very difficult even to close down because you have to complete all the legal formalities of liquidation and ultimate closure. There are few disadvantages of the sole proprietors. The liability of the sole proprietor is unlimited. Now, this is an important concept you need to understand. Liability. What do you mean by liability? It's something which a business has to pay. Remember, in a sole proprietor's business, there is no distinction between business assets and the private asset of the sole proprietor. If the business assets are not sufficient to pay the business liabilities or obligations, then the sole proprietor may be forced to sell his private assets to meet the business obligation. This concept is called unlimited liability. It's very, very important. Just for the sake of comparison, in a corporate form of business, the liability of the owners, who are the owners? The shareholders or the stockholders are limited. Your liability is restricted to the capital you have invested in the business, nothing beyond that. So you can lose maximum the money which you have invested, right? But there will be nothing on your private property, which is not in case of a sole proprietor's business where the liability is unlimited. A sole proprietor has limited access to capital. As you know, a single person, he will be having limited borrowing ability, right? So he has to invest all the money required for the business himself. So a single owner will have limited capital raising ability, limited skills and capability. As you know, God has given us limited physical and mental capabilities, which restricts the limitation towards the business skills and capabilities. Feeling of isolation, because at times you will be left alone to take all the business decision. And finally, lack of continuity. A sole proprietor's business is affected by death, insolvency, and insanity of the sole proprietor. He dies, business is closed down. He goes bankrupt, business is closed down, so on and so forth. So these are all limitations or disadvantage of sole proprietor's business. A partnership. Remember, the UK Partnership Act defines partnership as the relationship amongst people who have agreed to share profits of business carried on by all or any one of them acting for all. This is the legal definition. So remember, there are few main characteristics of a partnership business. Minimum two and more people are required to form this kind of business. When I say more, what more? For that purpose, you need to look into the legal requirement in a particular country. For example, in UK, if you are doing a general business, you can have maximum 20 partners. If you are doing a banking business in UK, you can have maximum 10 partners. But if you are running a business where there are partners who are chartered accountants or solicitors or um, you know, lawyers, engineers, a firm of engineers, there is no such restriction. You can have any number of partners. So remember, in UK, there is a restriction on maximum number of partners you could have. You can't have more than 20 partners in general business, 10 partners if you're doing a banking business. Only for a professional firm, there is no such maximum number limit. What if you are doing business in UK and you are doing any general business, and if you have got more than 20 partners? Remember, this is not permitted by law, and you will be called an illegal association of persons. Remember, in the previous topic, I told you we are working, a business works in an environment, right? Those five environment I told you, the pestle, one of that is legal requirement. Remember what the legal rules of a country prescribes or suggests or permits. Remember, so partnership is an association of two or more people who co-own a business for the purpose of making a profit. It takes the time to create a written partnership agreement. Now, this is something important I would like to discuss, or let me discuss when I discuss about the disadvantages of partnership. Remember, a partnership has got few advantages. It's easy to establish if you compare in terms of a corporate form of business, right? It's easy to establish. Complementary skills of partners. You remember I told you that in sole proprietor there is limitation of skills. But when there are two or more people joining together to form a partnership, more people would be bringing their skills together. There is going to be division of profits. Profits would be divided amongst the partners in their agreed profit sharing ratio, right? When I say sharing profits, it's also sharing negative profits, which is nothing but a loss. I hope you understand. Larger pool of capital as compared to sole proprietor. In a partnership firm, since capital is brought in by more than two people, right, more than two partners, there will be more capital. Ability to attract limited partners. Now, this is something which is permitted by UK law. For a very long time, for example, in India, they did not permit partnership with limited partnership, in the sense the a particular partner having limited liability. But in US, they do allow a limited partnership in the sense that one except all the partners may have unlimited liability, but rest of the partners could have limited liability. I hope I explained the concept of limited liability. Since a large number of public money is not at stake, few people are involved in terms of ownership, so there is very little government regulation. There is flexibility in this form of business, And let's not talk about taxation, as you know that in this country or where you are doing your MBA program, there is no personal taxation. Well, as far as the disadvantage is concerned, one of the disadvantage is unlimited liability of at least one partner. In America, you may have a limited liability partners in a partnership business, but one of the partner must assume unlimited liability. I guess I explained you the meaning of unlimited liability. Means if business assets are not sufficient to pay, right, one or more of the partners will have to sell their private property to meet the business obligation. Capital accumulation, again, if the requirement of capital is large, even partnership with 2, 10, 15, 20 people will not be able to bring a huge capital. So there is again limitation of skill. This you need to understand in relative terms of a corporation. Thirdly, difficulty in disposing of partnership interest. Again, try to understand with in comparison of a corporate form of business. Let's say you are a shareholder in a company or a stockholder. Today you are a shareholder. Tomorrow you may sell your shares in the stock exchange. Somebody else would become the shareholder. Means you can sell your shares to anybody you like. But in a partnership business, you are not allowed to sell your shares to anybody you like unless it is approved by existing partners of the business. Lack of continuity. A partnership business is also affected by death, insolvency, insanity of partner or partners, and it is also affected by, as you know, the existence of a partnership business depends on mutual faith and confidence amongst partners. If the partners are not having faith and confidence, that partnership is not going to last longer. So there is a possibility of discontinuance of a business. So there is a serious lack of continuity, a possibility. As you know, if you ask me, I can give thousands examples of a sole proprietor, few thousand examples of corporate form of business, but it is very difficult to give even 50 example of partnership forms. You know, it is said that if a partnership makes continue for 5 years, it makes a history. Potential for personality and authority conflict. As I said, that there is a possibility of conflict, misunderstandings, etc., which finally affects the continuation of a business. And this is very, very important for you to understand. The partners are bound by the law of agency. Remember, amongst the partners, there is a principal and agent relationship. Means the act of one partner will be binding on others, right? So maybe the other partners may have to suffer because of unscrupulous nature of a particular partner, right? So this is could be a serious disadvantage of a partnership business. Limited partnership, as I just explained to you in America, they do permit that in a partnership you could have limited partners, means those partners having limited liability, but one of the partner must assume unlimited liabilities, right? So remember, this is the limited partnership. There are a few things I would like to tell you about partnership business just to avoid conflicts, disputes, and misunderstandings, which may cost continuation of a partnership business. What partners could have is a partnership deed. It is a contract, right, expressly written in words and signed by all partners. So, what is a partnership deed? What does it contain? It's a written agreement amongst the partner. It may contain names of the partner, capital invested by each of them, their profit sharing ratio, uh, the name of the firm, and most importantly, rights duties, and liabilities of each partner. This is just to avoid the conflicts, misunderstanding, disputes. So, in the light of partnership deed, they could always resolve their conflicts, their disputes, just to make partnership business continuing. Sometimes we misuse some terms. I would like to explain this to you. There is a term called firm, FIRM. Remember that firm must be used for partnership firms only. You cannot you cannot say a sole proprietor's business a firm. You cannot say a corporate firm of business a firm, right? Remember, let's say there are four of us and we make a partnership, right? Individually, we are called partners. Collectively, we will be called a firm, right? But we will be doing business in a name. Let's say we call our firm Reliable Traders. So, Reliable Traders is the name of the firm. So, remember, whenever you are misusing the term firm again in future. Friends, the third and the last form of business is the corporate form of business. We call it corporation or company form of business. Remember, a corporation could be publicly held or it could be closely held. In general, if I say that a company is form of business where the owners are called shareholders, in UK or those countries which was ruled by UK once upon a time, right? They call it shareholder. But in America, the shareholders are called stockholder. Shares are called stock. It's basically one and the same thing. So let's say there is a corporation. It has got thousands of shareholders, right? Now, all these shareholders are the owners of the company. But those shareholders who have controlling interest in the company, right, they become directors in the company. They make a board that's called board of directors. They are at the helm of affairs and they take day-to-day business decision and they basically manage the company. The company may appoint, for example, a CEO who could be a paid employee of the company, right? And he may be running the company on behalf of the board. So, actually, a CEO would be basically accountable to the board, and the board is accountable to the shareholders. At the end of the financial period, based on the business done by the company, whatever is the profit will go to the shareholders in the form of dividend. So, part of profit which you get in a company out of your ownership is called dividend. Remember, I was telling you the corporation. A corporation could be publicly held or closely held. In UK, they call it public limited companies and private limited companies. A publicly held company or public limited companies are those corporations that has large number of shareholders and whose stocks are usually traded on the stock exchanges. For example, your company is listed in New York Stock Exchange, so your shares could be traded. Traded means purchased and sold there, right? Whereas you could have a closely held corporation, or in UK they call it private limited companies. In India also they call private limited companies, or those countries which was a Commonwealth nation, let me call it, countries ruled by UK once upon a time, they call it private limited company. Here, a corporation's shares are in control of relatively a small number of people, often family members, relatives, friends. In India, remember, in private limited companies, the minimum number of shareholders required was 50 and minimum was 7 and maximum was 50. So it is basically closely held. Shares are not issued or offered to public for subscription. Remember, friends, Corporate form of business is miracle of 21st century, I would say. When after the industrial revolution, goods were started to be produced in anticipation of demand, and when businesses needed large capital, it was beyond the capacity of one single sole proprietor or few partners to bring that kind of capital. So the need for this form of business was felt, and corporate form of business is the result of that. Here, thousands or rather millions of people could invest their money in one single corporation. So, if you ask me, one of the advantages of corporation is its ability to attract large capital. Billions, millions uh, could be issued to the shareholders, companies could collect, and it could do large businesses. Remember, as I have already explained you, like in sole proprietor, the liability of the sole proprietor is unlimited, whereas in corporate form of business, liability of shareholder or stockholder is limited. That is why it is called LLC here in UAE, because it is nothing but limited liability company, means owner's liability is restricted only to the amount of capital invested by him in the business, right? The company's liability, let's say company is unable to pay its liability, it is not going to affect the private property of the owners ability to continue indefinitely. Shares are easily transferable. Because of that, the company form of business enjoys perpetual succession or continuity of business. This is one of the important advantage. So as you could see that there are companies in business for more than 150 years, 180 years, right? This form, or they may continue doing business for several hundred years, because here the ownership is easily transferable by sell or transfer of shares, right? Because of that, it enjoys perpetual succession or continuity. And the last point is transferable ownership. Remember, I told you about partnership business. A partner cannot easily transfer his shares to anybody he likes outside the firm. First of all, probably he'll have to offer his shares to the existing partners in case if he wants to leave the firm. Whereas in company form of business, you don't have to ask anybody, right? You just have to ask your stockbroker and he will sell your shares, right? So share ownership is easily transferable. Like the advantages, friends, this form of business is also having some of the disadvantages you need to understand. The cost of formation and the time which requires to form the corporate form of business, right, could be taxing. It takes a lot of time and a lot of investment. The second disadvantage is double taxation. Remember, as a company, the company's income is taxed. When the company distributes its income to the shareholders in the form of dividend, then dividend is also taxed in the hands of the shareholders. This is called double taxation, which is considered as drawback. Means the same profit is taxed twice, once in the hands of the company and then in the hands of the shareholders who are actually the owners of the company. Potential for diminished managerial incentive. Remember, friends, there is always a difference between ownership and control. As a shareholder, you are the owner of the company, but you may not have any rights in the management of the company. The company management is in the hands of the board, which may even appoint a CEO to manage the company. So there is a clear distinction between management and control. This is considered as one of the serious weakness. The legal requirements and the regulatory red tape is considered as one of the disadvantages. As you know, a large number of public money is at stake. Because of that, company form of business is subject to a lot of government regulation. So, a lot of formalities, procedures are required to be fulfilled before a corporation is allowed to do certain things. So, there is considered as one of the drawback. And finally, potential loss of control by founders. I guess you might have heard that the Apple's founder once, even he lost control over his business. The company which he formed, Steve Jobs, the company he created, and once he was out of the company, right? So there is potential loss of control by the founders. So these are some of the disadvantages of corporate form of business. What we have considered in this chapter is the legal forms of business organization. As I discussed, sole proprietorship, partnership business, and corporate form of business. These are the three. Uh, the business plan you are making, you have to decide that what is going to be your legal form. So, the discussion which we have had today will help you to deciding the nature of ownership. Thank you.